All right, we're going live. Let's address the second side of this. We're almost done with this chapter. But here we got to go a little slow because it is complicated terms. All right, so we're live. So income approach. Income approach or income capitalization approach to value is based on the present worth of future rights to income. It assumes that income derived from a property controls the value of that property. So make sure you guys highlight and put stars. The income that a property brings determines the value of the property. The income capitalization approach is used in valuation of income-producing properties. Apartment buildings, office buildings, shopping centers, and the like. Because this type of properties don't have many sales to compare to, and because they generate income, there's an easy way to know their value. Like churches and hospitals and so on, they don't generate income. That's why the cost approach will be more effective in that appraisal. In using the income approach to estimate value, an appraiser must go through the following steps. Estimate annual potential gross rental income. Where it says annual potential gross rental income, I want you to write assuming 100% occupied. Assuming 100% occupied. So this is the potential of this particular property. Now, based on market experience, we're going to deduct appropriate allowance for vacancy and rent collection losses. Because do we keep it occupied 100% of the time? No. So there might be like a 5% loss, for example. Right? So I want you to put IE, so in example, 5% loss or vacancy. And this brings us to the effective gross income. So the effective gross income is the number that we need to account for. That's I'm going to get more or less this every single year. You got it? So if it was 100% occupied, we have a beautiful life. But because we know it might not be 100%, let's calculate worst case scenario, which is vacancy losses to reach the effective gross income. This is what we're really going to get.
Did I hear you say before that earlier that if you always have 100% occupancy, your rent is too low?
No, you did not hear me say that. That's it was in the previous chapter.
Right, that's what I heard you say.
No. What we said in property management is that having 100% occupied, you might consider raising the rents.
Okay.
Might consider. Doesn't mean it's too low. It just means there's a high demand for that particular property. So when there's high demand, can you increase your rentals? Absolutely. Supply and demand, as we went over in this chapter. Now look what it says. Based on appropriate operating standards, we're going to deduct, please underline, deduct the annual operating expenses. So there's income minus expenses, right? And that's where we reach, please highlight, underline, put stars, arrows, bubbles. We reach the number we need, which is called annual net operating income. Annual net operating income. Annual net operating income. Good so far? Yes? Okay. So we have 100% occupancy, right? Now this is called potential gross income, right? Minus 5% in example, right? Loss, right? Vacancy and so on, right? We now reach 95% occupancy, and this equals effective gross income. This is the number we need. Effective gross income. Once you reach effective gross income, which again is the number you need as far as income, now we're going to deduct what's called expenses. So minus, let's say in an example, let's say $35,000, because it has to be an actual number, not a percentage, right? So this equals expenses. We put here IE, which means in example, right? Expenses. Now, effective gross income minus expenses brings us to the number we truly need, which is the annual net operating income. So let's say, as an example, the annual net operating income is $50,000. So again, in example, $50,000. This was the NOI, and NOI is representing annual. Okay, your focus should be right here. PGI minus vacancy equals EGI. EGI minus expenses equals NOI. That's where we should be focusing. So on the left, I have numbers, just to give you an idea, assuming 100% occupied, minus a percentage for losses, gives you 95% occupancy, minus, let's say, $35,000 expenses, an example, right? It gives you $50,000. But the process is this. This is what you need to remember. We need to reach this number, NOI, for the next step of the calculations. Good so far?
What's PGI again?
Potential gross income. So that's assuming 100% occupancy.
What's EGI?
Effective gross income after the expected losses. Good?
IE is
In example. It just means, because there I cannot put a percentage for expenses or a percentage for the NOI, so I just put a number there in example, right? But again, the main focus should be what's here. PGI, 100% occupied, minus vacancy losses equals EGI, effective gross income. What we can expect in income from this property. Now, to figure out how much the property is worth, we need to figure out how much we take home. What we take home is after expenses. So EGI is like your paycheck. It shows what you should be getting, and then deductions and what you actually take home. That's the N, the net, O-I. You guys got it? Just like your paycheck, there's deductions.
NOI is the net?
Net operating income. You got it right here. Okay? So, some people come to me and say, Bruno, I make $20 an hour. Here's my question. Is that before or after deductions? Well, it's before deductions. Then that's not how much you make. Do you understand? Because I cannot count with $20 an hour. I have to count with 17, with 16. But do you understand what I'm saying? That's the money that I actually take home. Everything else is for a future benefit. Retirement, disabilities, and all that stuff. Yeah, I make that money, true, but it's set aside in a reserve. How much do I get now is what comes home. So you telling me $20 an hour means absolutely nothing for investment purposes.
When
Okay.
you work like as a contractor, I mean, when you work as a contractor, it's the $20.
Well, yeah,
But
because there's
when
no,
in the end, anyway, you have to pay.
yeah, true. But there's no deductions immediately. That's what I'm trying to say. What comes to your pocket right now? We'll deal with taxes later in that sense. But as a W-2, you make $20 an hour? No, you make less. You make $50 an hour? No, you make less. I need to know that number when I'm sitting down with you explaining, like when we talk about fortune builders and all that stuff, it's the same scenario. How can I help you invest if I'm accounting for your gross income versus your net income? How much do you take home after all the deductions? That's what matters to me. For mortgage purposes, they look at the gross. For investment purposes, I'm going to help you determine it by the net. What is safe for you? You got it? Because like Ron said when we were in mortgages, you said that what if your 401k is deducted from there? What if there's other deductions? Then the gross versus net is a huge difference. Do you understand? Can I account with your gross for investments? No. You guys got it? So, we reached annual net operating income. Management costs are always included as operating expenses, even if the current owners also manages the property. Mortgage payments, including principal and interest, however, are debt service and not considered operating expenses. So, what are operating expenses? It's the cost to keep the light open, right? So, electricity must be paid, water must be paid, gas must be paid. Fixed expenses are operating expenses. Taxes, you got it? Maintenance,
So they're
management.
They're telling you what management costs, you gotta include paying yourself?
Absolutely. Because, Ron, I'm buying the building from you, but I'm going to give it to somebody else to manage.
Right.
That cost should be there.
Right.
If you're managing yourself, you should pay yourself. That's, like, we're talking about investments tomorrow, but that's rule number one of investments is pay yourself first. If not, then what's left over? You understand? And that's the biggest mistake we make is we take the money and enjoy the money. No, pay yourself first. Invest in yourself, and then we'll move for other things. Next, we're going to estimate the price a typical investor would pay for income produced by this particular type and class of property. This is done by estimating the rate of return or yield that an investor demands for the investment of capital in this type of building. Please highlight, underline, put stars. This rate of return is called capitalization or cap rate. Have you ever heard of cap rates before? I'm sorry?
Didn't we talk about cap before?
We talked about cap in mortgages. Totally different.
It's not more.
Here is not cap like you're capped.
Oh, okay.
Here is rate of return. What do you expect in return for your investment? Capitalization rate. We just shorten it out to be a cap rate. And this is determined by establishing or comparing the relationship of net operating income to the sales price of similar properties that have sold in the current market. For example, comparable property that is producing an annual net income of $15,000 is sold for $187,500. The capitalization rate is $15,000, so the net income, divided by the sales price, $187,000. What is the cap rate? 8%. Okay? So for this particular property, the cap rate is 8%. If other comparable properties, similar properties, have sold at prices that yield substantially the same rate, so if everybody around is similar to the 8%, then we can assume that in this area, people expect an 8% cap rate. Good so far? It's like comparables. So the final thing we do is we apply the cap rate to your property annual income. And this results in the appraiser's estimate of property value. With the appropriate capitalization rate and the projected annual operating net income, the appraiser can obtain an indication of value by income capitalization approach in the following manner.
That whole section confused me.
I know. I'm gonna help you right now. In the next page, it says NOI divided by cap rate equals value. What is NOI?
Net operating income.
After expenses. That's what you have to say.
Mhm.
Net operating income. I know what the acronym means, but what is it? It's after expenses. Okay? So after expenses, how much money comes to my pocket? You divide that by the cap rate that we compared with similar buildings, and we know the value of our property. So if my property brings $15,000 net, so it comes to my pocket, right? And the average cap rate in the area, capitalization rate is 8%, well, net divided by 8% equals 187,500. How much is my property worth? 187,500. Yes, no?
Value of the property.
That's the value of the property.
8% of 15,000.
Yeah. Okay, calculators. I'm going to give you an example right now. No, it's just something simple. Let's say the cap rate in this area here is 7%. Let's say your property brings $200,000 net. Go ahead, calculators. 200,000 divided by 7%. $200,000 divided by 7%. How much is the property worth?
$186.
I'm sorry?
186.
Say that
Two
again.
million. 2,657,142.
Yeah, like
What numbers did you get?
Millions.
2 million.
2,857,142 without 86 cents.
Okay. So how much is this property worth? 2.8 million. It brings 200,000 at a 7% cap rate is worth 2.8. So we're going to sell the property for, or list it for 2.8. How do we get to the 7%? We look at previous sales of similar buildings, and we look at what their cap rate was. That's the acceptable rate. We apply that to the income of our property, and that gives us the value of the building.
Do that longhand.
Longhand.
Well, no.
All right, so in this case, the NOI is 50,000. We already figured out, right? We make, let's say it's $200,000 we made here, minus 5%, minus the $35,000. This is how much we take home. 50,000, right? We're gonna look at property A, the cap rates for property A after we checked the comparable sales, cap rate is 7%. Property B, the cap rate is 7.25. Property C, cap rate is 6.75. Property D is 7% as well. If you're going to look at the average as an example, let's say the average is 7%, then that's what in this area is acceptable. So in this scenario, it would be $50,000 net, right? NOI divided by 7%, which is the cap, and that equals value. What is it?
714,285.71.
Right. So that's the value of this property that we went through right here. But we need to compare to properties in the area. Okay. For state exam, they're going to give you the cap rate. You don't have to figure it out. In real life, once you start dealing with commercial properties, now you have to know, and your broker will train you on that. Okay? But what you need to know is how to calculate cap rate. They'll give you the 7%. They'll give you the net income or gross income and expenses. You just need to reach the net. Okay? You need to reach always this number. That's what you need to know. Like I said, you need to focus on this process. 100% occupied minus vacancy, EGI, minus expenses, NOI. That's what you need to focus. Because the exam is either going to give you one or all of these pieces of information for you to reach NOI. Once you reach NOI, the question already comes with a cap rate of 7%. So all you have to do in the exam is to apply 50,000 divided by 7%, or variations of this formula, which are income divided by rate equals value, income divided by value equals rate, or value times rate equals income. These are the potential variations of the formula. Here's the thing, they're going to give you 2 out of 3. So all you need to do is fill in the blanks. 2 out of 3. Don't worry, because on Tuesday, we have a math chapter, and I'm going to give you a tool which will help you figure out when to divide, when to multiply. So all these formulas will be blown away. You don't need it. You need to know how to fill in the blanks. Okay? Yes? Ronnie, you just lost another hair. I saw it drop. I saw it from here. He's looking at it like I was like, ping. Don't stress about it. Okay? I have to go through the formulas, but I'm going to give you a simple tool that you're going to use for the rest of your life with everything, not just real estate. Okay? You guys good? Okay. Next thing we have is gross rent or income multipliers. When appraising an investment property that produces rent or income, the sales comparison approach can include comps based on the income of similar properties that sold recently. A gross rent multiplier relates the sales price of a property to its rental income. Gross monthly income, gross rent multiplier, I'm lost for a second. So gross rent multiplier relates to the sales price of rental income. Gross monthly refers to residential, and gross annual refers to commercial or industrial property. Okay, so if it says annual, it's commercial property. If it's commercial property, it's annual. If it's residential, you look for monthly. Make sure you underline exactly as it is here.
Just a quick question on the last part, the cap rate. Is there a good number for cap rate and a bad number for cap rate, or
Nope.
No?
The good number is whatever you find in the area.
Oh,
A lot of people say the highest percentage is the better. Grab your calculator real quick. 200,000, as we did before, divided by 12%. So wait.
1,600,000.
So wait, with the 7%, it was 2.8 million, but with 12% is 1.6.
1.66 million. How much was the other one?
7%. My point is, a lot of people want the high numbers. There's an entrance and there's an exit cap rate. Unfortunately, in this class, I'm not going to train you on that because that's when you go commercial. And we're not training on commercial, I'm training you on how to pass the exam. And then whatever route you take, once you're out there, that will lead you to learning these different cap rates.
Okay.
But a higher cap doesn't necessarily mean higher value.
Okay.
Okay? And so many realtors still make that mistake. I know people with 10 years of experience, 15 years of experience, 20 years. Oh, the higher cap rate, the better. The opposite. Anyway. Sorry, just taking something for the throat. Otherwise, I won't be able to speak in the next 5 minutes. You good? All good? Yeah. So what is a good cap rate?
lower one.
Any cap rate.
It depends.
Depends on the market. Depends on what the market demands. The best cap rate is the one that gives me the most money in my pocket. Could be a higher one, could be a lower one. What I care about is the net income and how long it's going to take me to get a return on my money. Okay? What I'm trying to say is that it's not that simple. It's not just the cap rate. All right. So we're talking about gross rent multiplier. What happened?
It's stressful.
You just lost another one.
Yeah, exactly. I feel stressed already.
Even his beard is getting thinner and thinner. It's not that hard. It's hard now because you guys are not in it. Like I tell you right now, the best way to learn these things is by doing it. Right now we're going over theory. That's the worst part. You could be, but it's not until you do it. Okay? So hands-on experience will be the best. Don't stress about it. Your focus right now is passing an exam. I'm not teaching you real estate. I'm teaching you how to pass an exam. That's all. Okay? Good?
Got it.
Okay. So gross rent multiplier, we'll talk about it. Right? It says right here, the sales price divided by rental income equals GRM, gross rent multiplier. For example, if a home recently sold for $200,000 and its monthly rental income was $1,400, then the GRM for the property will be computed in the following way. 200,000 divided by 1,400 equals 142.86 GRM. Why is GRM, this number, so important to you? Because if we compare properties in the area to what they sold for and what they brought in rental, let's say residential properties, right? Then we can see that there's an average established. Like, on average, a 3-bedroom here is like $2,400. On average, right? So a 2-bedroom will be $2,300 or $2,200 as an example, right? Based on that, I can establish what's called a GRM. So if my property brings in rental $1,500 a month, do you think it's worth more than this property? This one brings $1,400 a month. Mine brings $1,500 a month.
Sure.
Absolutely. So, guys, calculators, what you have to do is find the acceptable GRM and multiply your rental income to the GRM. So 142.86 times 1,500, my property is worth $214,000. Is $214,000 more than 200? Absolutely. You guys got it?
Only 142.86.
142.86 times the 1,500 that my property brings. 142.86 times 1,500.
214, 290.
You probably deserve 14,000.
Because he brings $100 more a month. You got it? So the GRM is what's common amongst the rentals. So the rental could be 1,500, because if you divide now 214, you divide by the 1,500, it's 142.86. You have another property that's 300,000, and you divide by 1,800, as an example, it might be 142.86. This is the average, just like cap rates, is the average gross rent multiplier. And because it says multiplier, that's what you do. You multiply by your rental income to determine the value of your property. You guys got it?
So if I go up to a realtor and
They don't know.
try to sound smart and say, what's the GRM on this property?
Good luck. Good luck. Have fun with it. The GR who? Did you guys understand this? Before I move forward? Sorry? It's the same thing that we did here. We figure out comps. Let me erase this.
That's the hard part. That looked like Chinese. Find the NOI.
Oh, find the NOI. In this case, it's not NOI.
I don't know. I'm saying the like that.
It'll be a lot easier once we do the actual math, but
Yeah, that looks like Chinese.
The NOI is this.
Oh yeah, no, I have it written down here, but
Okay.
still.
So it's these steps right here. 100% occupied minus vacancy minus expenses, NOI. So it's actually easy once you apply it. That's what I said. Once you apply it. Right now, difficult, but once you apply it, it's easy. So the GRM, we're going to have property A, B, C, and D. Same thing. Okay? One property sells for $200,000, and the rental is $1,400. The other property sells for $214,000, and the rental is $1,500. The other property sells for $230,000, and the rental was $1,800 as an example, and so on. A property sold for $180,000, and the rental was $1,100. All this as an example. If you divide 200,000 by 1,400, it's 142.86. 214,000 by 1,500 is 142. It's not 86, but it's close to it, right? If you divide 230,000 by 1,800, I'm just giving you guys an idea. It's 142. I'm not saying this is the exact numbers. And this will be 145. All right? Again, I'm not saying this is the exact numbers. You don't have to calculate. The idea is now we have 4 comparable properties. Then we're going to find the average. What's the acceptable rate here? So to find the averages, the easiest way is we add them all and divide by 4. There's 4 comparables. If we add them all and divide by 4, then we know what the average is. Now you can calculate if you want. So I'm just assuming these are the numbers, not 100% correct, okay? But 142.6 plus 142.6 plus 142 plus 145, divide by 4. What number do we get?
So 145 is the last one, right?
Yep.
Yes.
All right. So it is assumed that the GRM in the area, the common denominator between all the properties in the area is 143.18. You guys got it? Are we good so far? So if my property brings $2,000 per month, right? I'm sorry, gross rental income. Brings $2,000 per month. I need to multiply it by 143.18. How much is that? 2,000 times 143.18. It's more, but I know. I'm just rounding it. Yes. You're right.
It's a 7, right? Divided by
What's a 7?
after GRI?
Month. I'm sorry.
Oh,
Per month. Listen, I got teaching skills. I never said handwriting. So $2,000 GRI per month, right? Times 143.18 says that my property is worth 286, more or less. Did you guys understand? Charlie? You good? So we went to 4 different properties at least and figure out how much they sold for and what income they had. The average of these resulted in the GRM. That means in this area, what is the gross rent multiplier? 143.18. If our property brings $2,000 a month, the one we're trying to sell, how much is it worth? 2,000 times the GRM that we figure out, it says the property is worth $286,000. So we're gonna list it for 286 based on the income that it brings. Questions? Any questions? No? All right. Moving forward. Here's the formula. We just went over this, just highlights. Ready? Next page, we have reconciliation. So before the break, we talked about the sales comparison approach, and we talked about the cost approach. After the break, we've been talking about income approach, right? Yes?
Yes.
Thank you. So we have three different types of approaches to value on how to figure out what's the value of a property. Some are more accurate than others, but what we need to do is now reconcile the records, put them all back together. So we had individual records with individual approaches. Now we put them together because that's what reconciliation is, putting it all together, right? And figuring out what's most accurate and what's the most definite value for it. Okay? That's all you need to know about it. At the bottom says appraising. All the way at the bottom says appraising. And it says not all estimates of value of real estate value are made by professional appraisers. The real estate licensee, you guys, must help a seller estimate a market value for his or her property without the aid of a formal appraisal report. How do we help a buyer or a seller determine the value of a property? Comps, CMA. So it is necessary for everyone engaged in the real estate business, even those who are not experts in appraisal, to possess at least fundamental knowledge of real estate valuation. Now, formal or informal appraisals may be required in numerous situations, such as estate purposes, divorce proceedings, financing, taxation, relocation, condemnation, insurance, damage loss, and feasibility. So there's a lot of reasons why we do appraisals, not just for the sale of the building, but also for insurance, divorces, and so on. Okay? We have two different types of appraisers. We have the fee appraiser and we have the staff appraiser. Look how I have it highlighted. A fee appraiser works as an independent contractor who offers services to a number of different clients. A staff appraiser is an in-house employee of organizations like FHA, lending institution, or large corporation. What you need to remember in the state exam is fee appraiser, independent, staff appraiser, employee. Okay? That's why I have it highlighted the way it is. Fee appraiser, independent, staff appraiser, employee. Good? Next, we have the appraisal process. Where it says appraisal process, you guys need to know that this is divided into basic classes, the way we obtain info. We have general data, which covers the nation, region, neighborhood, and so on. So social, political, economic situations or influences, right? And then we have specific data. This is specifically on the property. What type of property is it? So everything we went over. The cost, the income, the structures, all that is the property itself. So general data that affects the property. So New York has a different market than we do, right? Those are things to consider. And then the final thing on the next page is that the appraiser prepares a report. So here's the appraisal process. We're going to state the problem. So what we're looking for, right? We're going to list the needed data needed and sources. We're going to gather, record, and verify the necessary data. Determine the highest and best use of the property. Estimate the land value. Estimate the value by each of the three approaches. Put them all together. So everything we went over so far, right? And then create a report on the final value. This report, just mark the bullet points, should include, obviously, identify the real estate and the real property that's being appraised, the purpose of the appraisal, the value to be estimated, the effective date and value of the data reports, the extent and process of collecting, confirming, and reporting the data, listing all the assumptions and limitations, yada, yada, yada. So everything we went through should be detailed in the report. And at the end, right on top, remember, yellow might be a question, right? In the end, there must be a signed certification. So the appraiser cannot just give a report without signing. And that signed certification says, I am a certified appraiser and been doing so for X amount of years. It is my professional experience that this property, in my professional opinion, that this property should be worth X amount of dollars. So an actual report signed, certified, according to the uniform standards of professional appraisal practice. Okay? At the bottom it says New Jersey. Do you see it? You see at the bottom where it says New Jersey? Great. New Jersey requires that appraisals performed by as part of a federally related transaction comply with state standards and be performed by a state licensed or state certified appraiser. An exception is allowed where a broker's price opinion, underline broker's price opinion, is acceptable to a lender. The BPO, underline BPO, the BPO should include a statement indicating that the report should not be considered the equivalent of an appraisal prepared by a New Jersey licensed or certified real estate appraiser. So a BPO is our opinion. An appraisal is the appraiser's opinion. You got it? Appraisals are done by licensed or certified appraisers, not us. And this statement should appear in print size as large as the main text on the report. At the bottom it says, all real estate appraisals for any purpose must be done by a licensed or certified real estate appraiser. Didn't we just go over this? Okay, you think it's important that you guys remember this? Yes. But there's exceptions. And the only exceptions are, skip a page, for CMAs provided to sellers or buyers, and BPOs ordered by lenders. So CMAs are comps that we give to the client. BPOs are comps that we give to the lender when we dispute a mortgage, for instance. Okay? Any questions? What are BPOs for?
Lenders.
Lenders. CMAs?
Buyers.
Great. All right. We're done. But Ron, you had a question before. Right? I mean, you stated the question. Talked about being an appraiser. Sorry,
Oh,
not
yeah,
a question.
yeah,
You
yeah,
mentioned it,
yeah.
right?
You don't forget.
How many hours? I try not to. Sometimes it's difficult, but 90 hours, that's what you need? That's for you to become an apprentice. You need 90 hours of appraisal study. You want to be a licensed, not certified, a licensed residential appraiser, you need 150 hours of classroom hours, right? And 2,000 hours of experience in less than 1 year. To become a certified residential appraiser, you need a master's, an associate degree. You need 200 hours in appraisal courses plus 2,500 hours of experience in at least 2 years. You want to become a certified general appraiser when you can appraise properties of more than $1 million. You need 30 semester courses, 300 hours of approved real estate courses, 3,000 hours of apprenticeship in 2.5 years. At least 1,500 of these hours should be spent on non-residential properties. Who wants to become an appraiser?
I asked that part.
Go for it. To be a licensed general appraiser, you need to have a bachelor's degree or higher. And of course, all these hours experience and all that good stuff. Good luck with that. All right, guys? Any questions? I'm treating you guys too well. Leaving early again? It's 1 o'clock. It's not 1:30 yet. All right. I'll see you guys tomorrow. Make sure you are studying, please. You're going to start studying today, you said?
Yeah, I've been slacking off last week.
See you.